A choppy day on Wall Street as Trump's Liberation Day approaches. Ann Bartels of Sanctuary Wealth, how big a week is this for stocks given Trump's planned tariff escalation?
So I still think that we're in a period of volatility or markets being choppy until we can have some clarity on where tariffs are. And even if we get tariffs from Trump on April 2nd, we don't know if we're going to have retaliatory tariffs. So tariffs might be in our dialogue for the market longer than we want to have this conversation.
So, where do you think that takes us in terms of stocks? Testing new lows?
Yeah, so today we've actually seen markets break their recent lows, but we do feel that we're in what's called a bottoming process or a testing process. Many of our indicators actually have buy signals. So, but testing can be a little bit painful. So just because we broke to new lows doesn't mean it's negative. So we're of the view that we're in this bottoming process, that you need to be patient. But for long-term investors, we do see value within the market. And so we remain buyers of this market.
So, what specifically do you remain buyers of?
If you can go back to the beginning of the year, all we talked about was artificial intelligence and how that was going to increase productivity. And now we're not even talking about artificial intelligence. So we do see drivers of artificial intelligence over time positively impacting earnings through productivity enhancements. But we have to get past these tariffs. We have to be able to price this in. In addition to that, we have to find out where the economy is. Where are jobs? What is the Fed going to be doing with interest rates? So there's still a lot of different moving parts to this market. But when we dial it down into a single outlook for the markets, we're reaching buy levels for those investors that were looking to buy in the market, particularly in the technology sector.
However, we're seeing lots of headlines about perhaps this is a shift away from US exceptionalism. Do you see this at all as a key moment in which many investors may or should pivot away from some US stocks and go towards overseas stocks or fixed income here?
So many US investors tend to be home biased. They tend not to look outside of the United States. But we do now see an opportunity in Europe. The German government has passed a bill where they're going to be spending close to €1 trillion on infrastructure and defense spending. That we believe will be very stimulative for their economy. In addition to that, their central bank, the ECB, is expected to cut interest rates. Typically, when interest rates go down, risk assets go up. So if we were looking to venture new money overseas, we would be looking at Europe. As for income or yield, for those investors that are in cash, and if those cash yields will be ending soon, in other words, maturing, we would continue to look for yield within the fixed income market, but you may not be getting that same yield. You may have to take what's called a little bit more duration risk or go out on the curve, or take a little bit of credit risk to get some of those higher yields within fixed income. But you can also get it in the equity market. We actually like utilities here, and utilities tend to have very good dividends. And there are other pockets like telecom that also have yield. And there are some ETFs that have yield. So we do think that you can build a basket of yield between fixed income and equity within the market. And we think that this is a good opportunity to do that.
Goldman Sachs today raised the possibility of a US recession to 35% from 20% and projected that the Fed could cut interest rates 3 times this year. What do you make of that assessment?
Well, the market has already been pricing in 2 to 3 rate cuts. So the market is already there looking for the Fed to cut rates. As for downgrading the outlook for the economy by raising their recession forecast, we've seen a number of economists on Wall Street actually raise their forecast for recession, but it's around 35%. So it's less than 50%. But what that means to the investor is that we're seeing a slower economy. It doesn't mean that we're necessarily having an imminent recession today, but there are signs that the economy is beginning to slow down, which is why we're seeing the Fed likely to cut interest rates. Over time, when interest rates come down, it tends to be positive for risk assets, but we're still probably in the early stages of that. But we think it would be very bullish over the next 12 to 18 months to have interest rates come down.